For part two, please welcome the panel on Global Capital Markets, moderated by journalist and anchor at CNBC, David Faber.
All right, good morning, everybody. Good morning, panel.
Morning.
Happy to be following the Treasury Secretary. Jane, let's just get started, if I can, with you. There's been no shortage of tumult over the last, let's call it 5-6 weeks in terms of the global capital markets. I'm curious from your vantage point at Citi, especially given so many of the activities you undertake for corporations around the world, what are you seeing? 4 weeks ago, we were concerned about the bond market. We had the dollar falling for a bit. It sort of seemingly stabilized as well. But, no shortage of questions at this point. Can you give us any answers in terms of what you're seeing in terms of confidence, for example, in U.S. assets?
Yeah, absolutely. Well, good morning, everyone. It's wonderful to be back and great to follow on the conversation with Secretary Bessent. It's certainly been a fluid few weeks, and there's been a lot that's been coming at us pretty hard and fast in terms of announcements and changes. But I think we've got to recognize that this is going to play out slow, and we've got to keep a perspective and be very mindful about what the longer term looks like amidst all the announcements. So if we break it down, if we look at just the tariffs, I think we're going to see 3 different phases that are coming through from this. The first is the one we're seeing right now, where we're seeing the pull forward of some of the spending from the consumers and from corporates. And we've certainly seen that in the April data. The hard data has been reasonably robust. Then you have the second phase that's coming through, which is going to be the fact that most companies are a bit in limbo land. There's a wait and see going on at the moment, where everyone sees how this will all play through. And in that, investment spending, some of that's been suspended. Some of the decisions on CapEx or on hiring has also been on hold. And that will have an impact on demand in the economy. And then finally, we'll find out exactly where the tariffs come into play. And in that, we'll have an impact on supply as well as on pricing. And as all of these different pieces come together, I think one of the big questions for all of us in the room is going to be, what is the magnitude of the tariffs? Because if it's 10%, most of the clients we talk to say, yeah, we can absorb that. If it's 25%, not so much, and or higher than that, and that's going to catalyze a very different set of dynamics. So at the moment, it's worthwhile sitting there, observing what's going on calmly, but being very mindful about what the long term is going to be, and looking for the indicators of how that plays out. That's what we're seeing most of our clients do.
Yeah, well, right now, obviously, China is far from 25%.
Yeah.
It's still on certain goods, 145%. There are obviously some exemptions. Each day that goes by creates at least the possibility of more tumult when it comes to imports and exports or the lack thereof. What are you hearing from your clients when it comes to specifically the impact from China as opposed to obviously the rest of the world, where I think there's certainly a much more constructive hope that something gets done, at least in the near term, that can continue to have that 90-day exemption in effect?
Yes. Well, what we're hearing from clients is they're prepping for headwinds. So as I say, they're pulling some spending forward, they're holding off on investment spending. Some of them are also pretty active in the markets. The markets are open, so we're still seeing clients strengthening balance sheets or getting some of the big strategic actions taken while they wait and see as to how this will play out. And then, but they're not, while they may not be acting on the supply chains, we're very much engaged all around the world with our different clients on what does it mean for their supply chain configuration. And they're very much in the mode of being thoughtful about what does it mean in terms of their strategies, which are is the world going to move in a faster way to a multipolar world? And therefore, what does that mean in terms of new partnerships, new opportunities, as well as where they need to play defense?
Yeah. Waleed, you allocate on long-term capital typically, but I'm just curious, given the current environment, how you're approaching things. Do you think of the U.S. in the same way that you did 6 months ago, for example? Has it sort of changed in terms of the rigor you're giving your investment decisions?
Thanks for the question, David. First of all, I think it's great to be here. Great to see so many familiar faces. I think the answer is in the question. So we are a long-term investor, and we've been allocating capital for a long time. Our horizons are generally not less than 7 or 8 or 10 years, and we've held investments for more than 20, especially those that we like and that keep generating the types of returns that we like. And so I think the word that I would use to describe what we're looking at today is deliberative. We're looking, we're assessing, we're figuring things out. We haven't stopped deploying capital because at the end of the day, I still believe that the U.S. is still the best risk reward, globally speaking, after having looked at the world. I do think that there might be a little bit more friction in terms of doing business, but I think that's going to be more of a short-term phenomenon as things settle down over time, as clarity and the new normal becomes more evident. And, for those of you that don't know, 42% of our portfolio is in the United States. So today, Mubadala is a $330 billion asset manager, and so that's over $100 billion that's here. I don't foresee that changing. Most of, I think, the best companies in the world are here in the US, and I think we're still going to keep investing in them. So since that general equation hasn't changed, I think right now we're just gonna just watch and see what other kind of interesting developments happen.
Interesting developments. Well, we heard the Treasury Secretary. I'm curious, though, in terms of that deploying that capital here, does it change at all your strategy in terms of either sectors or the way you're thinking about different asset classes?
So all the sectors that we look at, we essentially look at it a 3 to 5 year perspective. And so, like I said, we're deliberative. So what that means is every year we will sit down and decide what the big themes are going to be for the upcoming year. Remember what Mubadala is, David, and I think I'll just describe it for a few minutes for those that don't know us well. Mubadala is really 3 things. So first is the part that most of you know about, which is the direct investor. So we are like a private equity firm. And that is not just direct investments in private equity and non-listed companies, but it's also a large private credit business. It's also a real estate and infrastructure business. And so that together is a big part of Mubadala's portfolio. But Mubadala also has an endowment portfolio. So what I call our endowment portfolio, think Stanford or Harvard or MIT. And so we allocate capital to managers to obviously maximize medium to long-term return in that way. And we're quite competitive. And then the third part of Mubadala that people know less well is our GP-led business. So most of the time people think of us as capital allocators. But the truth is in our GP-led businesses, and we have 2 at the moment, we're the managers. Mubadala Capital, which is a up-and-coming alternative asset manager headquartered in Abu Dhabi, and MGX, which is our tip of the spear from an AI and technology investing perspective.
Right, one of the investors in Stargate, I believe, as well.
That is correct.
Yeah.
You're right.
I want to talk more about AI. Let me come to the other end there, Andy, and just get your perspective on the current state of things and what you're seeing from Prudential.
So thank you, David, and good morning, everybody. So I'm the new kid on the block 1 month in, so it's been an interesting month, to say the least. My perspective is obviously policy uncertainty is driving volatility, but I'm more focused on how that does impact both our institutional customers and our end consumers. And, we're seeing evidence of slowing down. We're seeing the level of investment, the hiring, coming to a slowdown, the number of transactions. Probably the best example we've seen is in our real estate business. Obviously, real estate went through a trough. And we were coming out the other side and seeing the market really pick up. But I will say, given the level of uncertainty in March and April, we definitely saw, fundings pulling back a bit and transactions slowing down a bit. So, I think the sooner that we could get the policy certainty, I think it'll be better for the economy.
Harvey, you agree with that?
Yeah, I generally, well, first of all, it's great to be back, everyone. David, good to see you. I think this is the 30th panel I've been on with Jane and Jenny. It's good to be back with my friends. I think it's worth taking a step back for a second. I generally agree with what people have said on the panel. I think when we came into the year, David, there was this extraordinarily high expectation and momentum, and everything was sort of pro-growth. And I think with the tariff policy, people were just left a bit confused and uncertain because it felt like such a shift dramatically in policy. And at times, this was compared to other financial stress periods, 2008, 2000, 94, 87. I think this is wholly different. I think there's moments where the market seemed a little bit fragile, but if you look today, the S&P is down a couple of percent. And so I think this is wholly different because this is a policy initiative that we've never seen. I actually thought the Treasury Secretary's articulation of how the administration is looking at this was actually one of the best I've heard, personally, in terms of how they think all this will knit together. But I will say, so at Carlyle, we're about $450 billion plus in assets. We have 23 employees, but we have 700,000 employees in portfolio companies around the world. And what's happened there, and I think that's where we get our best information because we have these proprietary KPIs, is at the ground level, it's very tactical and hyper-strategic right now. So if you're in an industry that was, let's say, highly impacted by tariff, then it doesn't necessarily mean that you stop importing, you shut down, you immediately move to a conservative posture. It really is about what's your relative competitive position. So if you have scale, if you have financial flexibility, you may choose, actually, even though if you're in a tariff-impacted part of the market, you may choose to lean in and be very competitive and buy market share. If you're more financially fragile. So what we're seeing on sort of the portfolio side is definitively a lean towards protecting capital, making sure there's maximum financial flexibility, not because people think we won't get to the other side of this, but it's a question of how long. And so how do you manage inventory? How do you manage your client relationships? But people aren't disrupting client relationships immediately. They want to make sure they protect those. And so I would say it's very much a period of uncertainty and wait and see. The flip side, I would say, I probably talked to more CEOs and more CIOs in the past 2 months, maybe in my entire life. I would say virtually all of them have finished the conversation with, hey, don't forget about us, we're open for business. We're not looking to rush to deploy capital, very similar to what Lee was saying. There's a hesitation. The risk premium is definitely higher, but people want to engage and they want to put capital to work. And at Carlyle, for example, we have over 80 billion of dry powder. So we are actively looking for opportunities, but again, risk premium's higher because uncertainty is higher.
Right. I mean, of course, it's an impossible question to answer, I guess, in some ways, but I'll ask it nonetheless, Harvey. I mean, when are you going to know? What will be assigned to you and to all of those portfolio companies you're referring to that I can feel much more comfortable about my long-term plan and deploying capital against it?
You directed the impossible question to me?
Sure.
Okay. No, I just want to make sure because I thought you asked Andy. Again, I think that all of it depends on how quickly the administration can walk through these negotiations. It's an extraordinary task, but my best guess is that over the next 3 weeks, to call it 4 months coming into the end of the year, we start to get significantly increased clarity. I do think, generally speaking, in our businesses, we feel confident, and the bulk of our portfolio really is services, so less impacted by this, but we feel quite confident that we'll come to a point of equilibrium as quickly as the administration can get there. I think the big question for all of us is just what happens with China. And personally, I think we would all agree, it is not a great outcome for the 2 biggest economies in the world to be in any sort of trade war. I think that would be pressure for both economies, and obviously that would bleed into the global economy. So it would be great to see progress, and that's why every time you see a headline in this uncertain time, that's why the markets respond so quickly.
Yeah. Jenny, give me your perspective from Franklin Templeton as well.
Well, so I think I completely agree with Harvey on the administration's doing a better job at articulating kind of what the plan is, right? You heard it, it's the interactive engine, trade, tariffs, and deregulation. I think that it is, what we need to see is, well, let me step back for a second. One of the challenges of the US geopolitical system is when you're elected as a president, you have about 2 years, really 18 months to get your legislation through. because the midterms come, usually it flips and you don't have control of the Congress any longer. And so what feels like chaos is really a push to get a lot done in a very short amount of time. And so, and that's a little bit scary to people, but if you think about it, right, first of all, the tax cuts are not tax cuts. They're an extension of existing tax plans, but they have to be funded. So how do you fund them? Well, ideally, you fund them by cutting some government spending. We're on an unsustainable path as far as the deficits, and that's hard to do, really hard to do in a 2-year period. The other way to do it is you fund it with things like tariffs, so tax increases. And so you go out and you say, and by the way, President Trump said this tariffs will generate $600 billion in tax revenues. Now, whether the CBO prices it that way, he needs about $400 to $450 billion a year to fund the tax extensions, right? So it's a great way wherever that comes out. So he can't cut too many deals until he gets the tax legislation through. And so I think those two things, now that they're articulating, are interconnected is really important. And so what do we need to see? The market would like to see a couple of deals cut, right? To know that the US really intends to play ball. So I think that's important. The second thing is we need to see meaningful progress on the extension of the tax cuts or the existing tax system with a couple of additional cuts in there. And if you get those two things, I think it's going to calm the market a lot. And I think that's what folks are looking for.
The Treasury Secretary did raise, as he has before, of course, unsustainable deficits. He mentioned 6.7% of GDP. Do you share that concern, and do you think that this 3-point plan that was outlined is going to address that?
Well, it's interesting because I think, you know what, just because the U.S. has the biggest current account deficit, people talk about, I'm not one to say I'm too worried about us importing too much. Our bigger issue is the $33 trillion in debt that has to be financed. And so, yeah, I think we are absolutely on an unsustainable path. And what's scary, and the Treasury Secretary's mentioned it, is we actually incurred that during great economic times, right? What you need is the ability for the government, when things aren't going well, to step up spending. And you need them to be much more conservative in good economic times. So I do think we're on a concerning path, and I think that the president understands that we have to address this, but it's hard, right? Because let's face it, it's fun to be on the other side of getting all those benefits. And so being it's like the parent who's going to be tough, right? To be the one to say we can't sustain this kind of spending from the government, that's a hard message.
Yeah. Jane, do you share the concern? I mean, it was only a handful of weeks ago, of course, there was tumult in the bond market, not specific to this issue as much as sort of overall concerns, but it may have in fact even pressured or given Secretary Bessent an opportunity to say to the president, hey, maybe we need to take a pause here. How concerned are you, for example, about the bond market in the scenario that we're talking about of
Look, I think
large
when
deficits?
we're all said and done and some of these structural imbalances, other changes get addressed, the US is still the world's leading economy, and this is the greatest capital market in the world. And that's in our own right. It's got the breadth, it's got the depth of the capital market here, but there's also the other pieces. Show me the alternatives. If you look at Europe at the moment, they've probably got much more urgency around much needed push for a savings and investment union. Europe has $11 trillion of savings sitting in deposit accounts at banks that could get deployed and isn't because they don't have the capital market that the US has, and they could have a much stronger one. Will this catalyze that happening? One would hope so. I am a bit dubious about it. So the US has the exorbitant privilege. The dollar is still the reserve currency of the world, and do we think this is going to catalyze moving to a multipolar world faster? Yes. But right now, the alternatives are not that strong, and we shouldn't be talking down the economic advantages that back in January, as we were talking about, and we were feeling great about the world, felt like all roads were leading to the US. Now some of that's more in question. Those advantages are unchanged. And I think that's the dose of reality when people are feeling fearful about the bond market, that when you sit back and say, where else does it go? And thank goodness there's not too many
Explain to me the multipolar world you're talking about. Just
Yeah.
give us a little more sense as to what you mean.
So the rest of the world isn't sitting still. at the moment. If you look out in Asia at the moment, many of the Asian economies are rethinking their relationship with China versus the US. We're seeing India, where there's tremendous dynamism that's happening there, and they're looking at certainly the beneficiary of some of the China Plus strategies that have been going on. But that's the icing to the cake. The cake is India itself and the domestic economy. You look at the Middle East, which is really exciting in terms of the dynamism that's happening there. The convergence of AI, the convergence of energy, and the opportunities there, those are really being seized. So that's taking over from Europe in many ways as one of the dominant parts of the New World Order. So all of these different dynamics, capital flows, financial flows, technology, energy flows are changing. US still plays, as Walid said, a very, very important role in all of this, but the rest of the world isn't standing still. It's moving forward and changing some of the partnerships.
Right, but does the US then lose out in part just simply because the others are rising more quickly?
Gradually, it's inevitable gradually, but again, this won't be happening in a 1 to 2 year time frame. This is more over the balance of a 5+ year time frame.
That change your opinion at all about having 42% of your assets in the U.S.?
You know it doesn't. but I will tell you something that I want to build on that I think Jane just said. And so, look, at the end of the day, one of the things that people realize is that there is growth in other parts of the world, right? Talk about the Middle East for just a second, and I'm so happy that you brought it up. I think, look at what's happening in Abu Dhabi and the UAE right now. You're seeing capital flows coming in at a pace and rate that we have never seen before. You're seeing the formation of and relocation of new hedge funds, new PE funds, those that are opening up new offices, the movement of wealth away from Europe and to a lesser extent from places like India into Abu Dhabi. So we've had more high net worth individuals open up family offices in Abu Dhabi. And I'll tell you what's really telling. So when you sit in the lobby of a hotel like this one in Abu Dhabi, 5 or 10 years ago, in the past, most of the conversations were with asset allocators and sovereign funds like us. Right. Meaning, people will come and talk to us and say, hey, I'd love to invest some of your money, which is great. And that's going to keep going, and I don't think that that's going to stop. But what's really interesting is that now you're seeing a huge percentage of those conversations not involving us. And so you're seeing these positive, virtuous cycles happening because this particular hedge fund is there, because somebody just opened up a new office in Abu Dhabi. And so at the end of the day, you are seeing an economy that is really emerging from an asset management perspective. We're forecasting growth north of 5% next year. So it really is a bright spot, both from an asset allocation perspective, growth, and also innovation and productivity.
Right. As a percent overall, though, I mean, of global GDP, it's still small.
It is. But we're growing.
Yes.
So David,
go ahead, Andy.
On that point, I think it's also important as capital flows differently. You know, we run global companies that are represented here, and it's important that we have local teams that do business in the local geographies, in local currencies, and that provides a diversification effect for our businesses. So as we talk about how things shift and morph, it's important that we have strength all around the world.
Yeah.
I was going to say, David, on the back of this, if you step back again, a lot of the trends that drove the last 50 years, declining interest rates, deflation, globalization, a lot of that was basically, and even though there were disturbances, capital was increasingly becoming more frictionless and getting deployed more easily around the world, but a lot of that coming to the United States. And I think that all the trends, which Jane just pointed out, really are maybe the next 5, 10, 15, 20 years, and we deploy capital over 7 and 10 years for all of our clients. And those trends are only going to increase the demand for capital. And so if we were sitting here 7, 8 months ago, we wouldn't have been having a conversation about Europe spending well over $1 trillion in defense. We wouldn't have had a conversation about the rebuilding of the Ukraine. We wouldn't have a conversation about onshoring, which may happen almost everywhere. But as we go through this rebalancing period, I see only capital demands going up. I don't know necessarily if that means the capital on a relative basis, less comes to the United States. I think the question is, where does all that capital come from? And that's why I said the marginal cost of capital will likely trend higher for the next 10 or 15 years, but the demands for capital will be extraordinary. Obviously, we will all play a very, very meaningful role in that as capital providers. But I think the capital demands are going to just go up significantly, and it's hard to say they won't come explicitly from sovereigns who mostly have, deficit issues to deal with. The banks hopefully will get some regulatory relief and be able to provide it. But as Jane points out, capital will mobilize. But there's going to be huge demand for capital, I think, everywhere in the world.
Yeah, Jenny?
I'm just going to add, it's important to remember it's not a zero-sum game, right? So the U.S. being successful, and if you say, well, some of that shifts to other places, is that bad for the U.S.? No, the reality is, and I was talking earlier, like, if you think about the iPhone, 90% of iPhones are assembled in China. If you think about PCs, TVs, iPhones, the fact that these are cheap, although that's not that cheap, but imagine about 3 times that expensive, how much ancillary businesses have been created? How many apps here do small and large businesses now have because of the proliferation of these? How much content is now available in streaming services because we've put all these PCs and televisions in people's homes? So when I come back on the zero-sum game, think about if we can unlock these economies. India, 1.4 trillion people, 56% of it under the age of 25, and start to get more consumers. China starting to get more consumers. How much the pie grows for everybody, including in the U.S. And the U.S. is a big services exporter. So we actually really benefit from that if we can ignite those. Africa is another massive opportunity to ignite those economies to start to get more consumer spending.
Yeah. I thought it was interesting the Treasury Secretary gave us a slide. We were backstage for a bit. We may have missed another, but the one slide I saw was, of course, on private credit. Having just come off air, having interviewed both Mark Rowan from Apollo and Jonathan Gray from Blackstone, might imagine I'm also sort of thinking about it as well. Andy, how do you think about it, the rise of private credit? Something we could easily and probably would have been talking about last year, but given this is a global capital markets panel, it certainly seems appropriate to discuss it now. Rowan will tell you that liquidity is overstated in terms of public debt and understated in terms of private. I'm curious from your perspective as an allocator, especially as well at Prudential, how you're thinking about it and how you're allocating towards it.
Yeah, so a couple comments. One, I completely agree with Harvey that there's a generational opportunity that's in front of us to rebuild infrastructure, to rebuild industrial capacity, and it's not going to be one spot that solves it. You're going to need government, you're going to need public, you're going to need private. I always bristle a little bit, candidly, as a 150-year-old insurance company about the rise or the discovery of private credit. We candidly have been doing private credit for a century. And have funded many, many things in the country. But we think it's a very positive trend. Candidly, a lot of the things we try and accomplish as an insurance company, helping people with their retirements, helping people with protected income, you need the appropriate types of assets and capital coming into the system. So the more that, candidly, new competitors have come to the space, new capital, and the more origination that's being done on the private credit side, that's a very positive thing overall for the business.
Harvey?
Yeah, I think these debates around the degree of systemically riskiness or marginal liquidity, I think they're kind of misplaced. I understand they're interesting and maybe they get some headlines.
Why?
I think that, well, I'll come back to that in a second, but yeah. I think the real issue is business operators are quite smart about how they source their capital.
Yeah.
They are expert at this. And so anyone who decides whether to, for example, take a company public, we took 3 companies public in the last 9 months, David, 3rd largest IPO in the US, largest privately owned business in India, largest privately owned business in Japan. People say, well, companies don't go public anymore. It's just not really true. But when you're making the decision about how you want to source your capital, you're basically just looking at the efficient frontier of capital and saying, where's the most effective marginal cost of that capital? What's the most durable form of that capital, and who's the best partner? And I think that is what's given rise to private credit. Now, of course, we've seen this evolution over 40 years. When Carlyle was founded in '87, was really just buyout and VC, and now the whole cap stack has been filled out. But I think, again, this is about business owners, CEOs, treasurers, CFOs, making the best choice they can about how they source their capital. Now, in terms of the points before, I don't know necessarily whether the debate around whether it's marginally less liquid or marginally more liquid, that's really about the convergence, I think, of the evolution of the industry going forward. But I also think that you know, the systemic discussion got a lot of eyes until, you know, we went through the period where we lost a couple of banks, but all the private credit vehicles, which are funded long-term, actually performed quite well. So again, I think that's really more about a liability issue, and we have very long-tailed liabilities, as Waleed and everyone has pointed out.
Yeah. I want to stay on private credit, but let me just come back to you on IPO activity, because you point out you're able to do them. But that said, I am curious as to how you think. I mean, we constantly talk about, oh, the return of the big IPO, and yet it doesn't ever seem to be here, and at least in size and in activity. Is that day ever going to come back? Or given what you just described, the opportunity to avail yourself of all sorts of different capital sources that can allow you to stay private, certainly.
So we've all seen these charts. In 2000, there were, you know, twice as many public companies as there are today. There's only 3,000 plus in the Wilshire 5,000. We should probably rename it. I think that my own personal view was I kind of felt we'd hit a bottom. We obviously have a reasonably big backlog of companies that would like to go public. There was a big wave after the SPAC bubble came through. I think the market needed to digest that. But I sort of felt like we were at a bottom and that we'd hit a new equilibrium. But again, I think that the demand for marginal capital will be so high over the next 5 or 10 years. If the public market exit is the most attractive, people will take it. If the private market exit is the most attractive, people will take it. And by attractive, it means all things. It means how regulated are the public markets? Is the burden of being a public company too high? All these things are in the equation. It is much more difficult for small companies. And maybe that'll change. It's really not the companies we deal with at Carlyle, but I do think those companies, the mid-market companies, it's much more difficult for them to go public. But I'm more optimistic, or I was. I think in the near term, very difficult, because you can't answer basic questions about the IPO, like, okay, what do you think about inventory management for the next 4 months?
Yep.
Hard.
Yeah.
Jenny or Jane, you want to both?
I was going to say, look, I think that there's no question that it is more difficult to be a public company CEO than a private company CEO. And I think that and this is where I think the administration's view on opportunities on deregulation, that it actually will help the public markets. So, you know, number one, there's tremendous pressure on quarterly earnings. That probably doesn't change that much. And so in a time of great economic advances, it can mean that companies hesitate more to invest in R&D that may not really impact the company. You hope that they're thinking longer term, but may not ultimately meaningful to earnings for 5+ years or something. So that's always a little bit of a risk for a public company. The second is the amount of regulatory just cost of being public. They estimate it's like 3% or something. I don't know exactly what the number of your operating expenses. Well, that's a lot in a public company as far as a drag. And so I think that until there's a little bit more of a level playing field on being private and public, that you're not going to have that IPO market kind of light back up.
Well, that's why I was saying I think it might have flattened out.
But, yes,
but I don't see it rebounding until some of these issues are resolved.
Jenny, from your perspective, does it matter anymore? I mean, do you private versus public, and the opportunities set?
Absolutely matters, because the average investor cannot get access to the private markets. And if you know, the average company's going public now, year 10, 12, even in some cases 15 years, if you have that early growth, that multiplier effect early on, and that's only captured in the private markets, it means the average American doesn't have access to it, which is why there's so much effort going in trying to figure out responsible ways to bring it. But remember, you know, if you're just living there with, you know, marginally having a few, maybe a year's worth of your income in savings that you're saving for retirement, and you suddenly have a crisis, you need to get access to it.
Right.
And if that's locked up in a 7, 10 years,
I mean, the effort's underway. ETFs, both for private credit and private equity, are there potentially, but daily liquidity, certainly when it comes to private credit, is an issue. I'm sorry, Jane, I didn't want to...
No, I wanted to build on what Jenny's saying, because obviously I very much appreciate Secretary Besson's comments about helping banks be able to do their day job, which is be freed up to be able to do more lending, to be able to participate in areas that have been more constrained of late. But we've got to focus on the win-win. And that win-win isn't just in terms of private credit and bank lending for companies, it's also on the savings side, as we talked about. It's also making sure that the consumers and the smaller businesses, the medium-sized enterprises, who are probably the ones that are going to be hit hardest in the short term by the changes that are going on, are also taken care of. So as we think about savings and investment, we're thinking about private credit. How do we make sure that you have got these democratization of private equity? How do we make sure that we're providing enough of the depth and breadth of liquidity so savings can be turned into wealth creation for the affluent and not just the big blue
How do you view the effort underway? Apollo's got an ETF now. It's small. Blackstone certainly may be BlackRock, one would imagine, is definitely focused on it in terms of allowing for some access for the retail investor into the private credit markets without great liquidity potentially, which seems to be at least some issue.
I think there's going to be a lot of focus and different alliances as different groups get together to look at how do you provide more of that liquidity, how do you provide the appropriate transparency, and how does this then become the vehicles. So I expect there to be a flurry of activity in the next year of different firms getting together and looking at how do we provide and serve this need sitting in for the affluent and the regular person's savings so they can tap into it.
Do you see private credit as a threat at all to your business?
No, for us, again, it comes back, there's a win-win here. It's not a zero-sum game. We've just been involved in a very big restructuring at Boeing, for example, and we put $800 million into the Apollo vehicle that we have a $25 billion partnership with. That's been a very important part of the toolkit at a point in the market where the public side wasn't going to be as available. So the more diversity of responsible tools and responsible options out there, the better for all of us.
Jenny, do you have, I'm sorry.
Yeah, I was just going to comment on the convergence or the ability to deliver, because as you mentioned, there are quite a few asset managers that have the combined private and public in ETFs and mutual funds. So at Franklin Templeton, we've been putting late-stage venture in our growth equity funds because we're headquartered in Silicon Valley for over a decade. And it was really because the team said, gosh, we're missing the performance kicker of those old IPOs. Can we do late stage venture? It took a lot to try to figure out how to do the daily valuations that you have to do.
How do you mark that? Yeah.
And so the vehicles allow for it up to 15%. Now you can't really be at 15% in case you get a soft breach. So you can kind of put in there 10% or something. And so I think you're going to see more of those happening. We actually, with Apollo, our real estate group in Apollo worked on a product in the 401k where we provide real estate, they provide the private credit for the retirement channel. You're going to see more of those, but you can't forget, and this is where I think it's really important to understand, illiquid is illiquid. Okay, so I don't agree with the private credit is as liquid and people underestimate because you have to go sell it. You're going to go sell it at whatever the market is. By the way, it's probably going to be, if you had to sell it right then, probably at a similar discount as the equivalent kind of bond trading. The reality is you have permanent capital, and so permanent capital doesn't force you to sell it at that point. But that doesn't mean it suddenly becomes liquid.
Yeah. Waleed, I think you'd wanted to make a point.
Yeah, I do want to jump in on private credit. I think to everybody's point, again, as a large sovereign, as an allocator, private credit has been the fastest growing asset class from an allocation perspective for the last 3 years. It's also been one of the best performing that we've had. And again, it goes back to this point, because it's another kind of part of your tool set for essentially how you both move up and down the capital structure and how you generate return. I think it's been incredibly successful. For us, our largest partnership, just like Jane, is with Apollo as well. And so we formed this partnership 6 or 7 years ago, and it's been incredible. It's interesting how it started. It started because we had this grand notion that we saw that there was this white space where we thought we could actually disintermediate some of the large banks. But to Jane's point, it turned out to be a complementary kind of piece of paper as opposed to saying, oh, well, we're going to do something that the banks weren't doing. Mm-hmm. And so it's fantastic how these kind of synergistic elements came together to create a new business that I think supports so many companies, globally speaking.
David, just jumping in. Another major driver, obviously, that will drive the private credit growth is really protected income. So when we talk about savings and investing, the country's done a lot on the retirement accumulation side, but we have 11,000 people turning 65 every day. The number of people over 65 is going to double in the globe in the next, between now and 2050. So really leaning in on how to help in the income phase of retirement, there is absolutely a role for the growth of private credit in that.
The reality is, David, that I'm sure it's the case for Jenny and for Andy. We've been managing money as a fiduciary on behalf of teachers, firemen, and government employees for almost 40 years. All the pension plans, all those retirees and potential retirees are already exposed to private markets. They're just being managed through their pension plans. So this is an inevitability, but I do agree with Jenny. The marginal liquidity demand for the user needs a very, very high level of care.
Yeah.
Because as she points out, when you have a long liability structure and there's no demand for marginal daily liquidity, it is very different than someone wanting daily liquidity. And that is an industry we just need to manage with a high level of care.
Yeah. In the time we have left, Waleed, I want to start with you. I want to talk a bit about AI and get each of you to sort of weigh in to a certain extent. But we were talking about, pools of capital. I mean, back to the IPO discussion, and you were part of this, or at least in some way. OpenAI raised $40 billion at one time, largely from SoftBank, from some others. And then the Stargate capital is, I don't even know the number of where that will end up. I mean, just talk a bit about that in terms of the opportunity set that you see there, why you're involved, and to put it in perspective, $40 billion I think is larger than any IPO that's ever taken place.
So we've taken a long-term view, David, that AI is very simply going to be the biggest productivity booster that the world economies have seen. And for us, we wanted to get involved really at the AI infrastructure level. We wanted to help be an enabler because we identified, I think everybody knows this now, that there were going to be energy constraints, there were going to be transmission constraints, data center capacity constraints, in order to enable what we think is going to be revolutionary from a global perspective. So we created MGX not too long ago. And maybe just a couple of points. Number one, I think we're probably the only sovereign investor that has positions from an LLM perspective in Anthropic and OpenAI and in XAI. Okay, so again,
they're okay with that.
Absolutely, they are.
Okay,
they are completely okay with it.
Capital's capital.
Capital is capital, but it's not just capital is capital because we're doing something interesting with that capital. That capital is also going to build out the infrastructure that everybody needs, right? Whether it's the Microsofts of the world or and so developing this capability and unlocking part of the energy puzzle, unlocking some of the transmission constraints that we've seen, globally speaking, and at home in the UAE, is really a key focus for us as we help kind of usher in this new era. We wouldn't have put as much capital as we have into MGX and into AI if we didn't think that this was going to be a long-term trend that was going to help kind of fuel growth, globally speaking.
Yeah. Jane, I mean, Waleed says a new era. Do you agree with that? And I'm curious what you're seeing. Now it's been a bit of time in terms of, at least since the introduction of ChatGPT in the fall of 2022. How are you using it internally at Citi, and what are your views?
There's a huge amount going on in around all of AI, the picks and shovels phase, the applications, the development. I would just make the side observation that this weekend's announcement reminded us that with Warren Buffett, that wisdom, there's nothing artificial about wisdom.
True.
So as we look at how AI will get used, what we're seeing is how do you help people and train people how to use AI in order to do their jobs better? And how do we look at this in a very practical manner? It's very easy with AI to have 1,000 flowers blooming all over your organization. So we're trying to get to fewer use cases where there's real scale. The first areas we're seeing in the agentic space is clearly with the coders, and I think many of us are certainly on the panel. Are we getting real productivity benefits from it? We're starting to see big benefits coming through in customer service. AI can be relentlessly empathetic in a way that a human being somewhat finds that challenging by 5 o'clock in the afternoon, sometimes 10 a.m. So we're trying to hone in on where are the scaled use cases that we can get benefit within the firm, and then also helping get the financings arranged for
On the
the
capital
huge
side.
amounts of capital required in the grid, in energy, in the data centers, in all these areas. I stole your phrase of picks and shovels, Jenny, by the way.
No, listen, I am, so first of all, I'm always one to believe that just the ingenuity of the human being, that these technologies, somehow we always find more jobs. So remember, the internet was going to displace a bunch of people, and who knew that Google was going to have, I don't know, 300,000 employees. Like, so first of all, it's going to change them a lot. And I'm reminded of a picture, Wall Street around 1900s, where it was all horse and buggies and one car, and then 10 years later, it was all cars and one horse and buggy. And I'm pretty sure that the people taking care of the horses didn't suddenly become mechanics. So there's a change in skill set. But I have to tell you, I spent some time this weekend playing around. I used to run the technology department, so I like this particular area, with an application where you just told it what to do. It's called Replit, and it writes the code and creates an application for you. Think about that. So I have my daughters are a singer, an actress, and a documentary filmmaker. So when my son became a computer programmer, I was like, oh, thank goodness somebody's gonna have a job. You know what? The jobs are gonna be the people who are creative, because they're gonna have a tool in their hand that they can take that creativity and actually have it programmed for them. So we have a partnership with Microsoft where we're working on something for our distribution team. And so it's agentic AI. You know, it starts out and it starts to, say, okay, I wanna go visit this client. What's the optimal set of clients that I should see, and two, what should I talk to them about? It goes into your CRM system, it goes into comparing our products to others, so multiple different databases, and then the agentic component says, and let me go look about this, say this advisor, and see what he's talking about on social media, right? So I can improve that. The reason that's important is because suddenly you've written the application layer and you made all your enterprise software almost databases. So it's going to pretty dramatically change how we leverage an IT department. So I'm very optimistic about
Well, that's nice. Nice to hear a little bit of, uplifting view in terms of AI. I don't know if you share that, Harvey.
Yeah, I would say, it's very easy to get focused in a world like today, very tick for tick, day to day headline, as I said before. I think 3, 5, I don't know if it's 3, 5, 7, 10 years from now, AI data science will have a much bigger impact than tax policy, tariffs, and all the stuff we talked about earlier. And so keeping a very, very firm view on that, I mean, we might be sitting here in 5 years, you might send your agent, there might be avatars in the room, people might attend multiple sessions at a time, and the data might be processed for us. There's a lot of extraordinary things. At Carlyle, it really is about use cases. And really identifying very specific use cases, whether it's in our portfolio companies, and how do we make them competitive? How do we work inside the firm? And inside the firm, it's really about what things can we source externally, off the shelf, as applications are developed, and what things can we do internally to use our own data. Your own proprietary data is really where the gold mine is, and we've been doing this for a long time, and so we have millions of data points on company historicals, EBITDA numbers, performance statistics, and how we use all that data is very front and center in how we're thinking.
Do you share Jenny's optimism when it comes to actual employment? I mean, when you look at Carlisle and the things that can be replicated as a result of, or with a machine as opposed to a human being, it seems like that
I'm
could be
generally
fairly large.
optimistic, so I think employment will be better, global peace will be better, deficits will be better. I'm an optimist. I'm a glass half full guy all the time. I think there's always transition. And transition can be challenging at times, and we won't know which parts of what industries get impacted negatively and which are impacted positively.
Yep.
But I think long term, I think very optimistically about it's very pro-growth.
Annie, let me end with you on this subject.
So obviously we're using it in many similar ways across code generation and across becoming more productive. But I would agree with Harvey from the perspective our most important use cases are where we have massive amounts of data and we can drive better decision making in the business. And our best example obviously as Prudential would be the way that we're using our data in underwriting and in better predicting mortality outcomes, because that ultimately is about competitive advantage and driving a much better bottom line.
Are you starting to see that already, or is it still too early days?
We obviously have seen all the productivity improvements in underwriting would be a great example, but we're seeing early evidence is the way I would frame it.
David, we've taken processes that would take teams 10 days down to 3 hours.
It's amazing.
Headcount's only going up.
Only going up. That's not going to result in a reduction in employment.
No, because we're processing more opportunities.
Yeah.
They're just doing them way more efficiently and more accurately with better precision. Much better ROI.
Well, that's a really nice place to end on an uplifting note, that perhaps in 5 years I'll still be able to be here physically as opposed to just some image of me.
Your job will always exist.
That's a perfect place to end. Panel, thank you all so much for a great conversation. Thank you all as well.
Thanks, everyone.
Thank you.